Have you ever wondered why a $100 bill is worth so much more than any other piece of paper? Sure, you can use it to pay for things, but you can't eat it or build anything with it, and burning it is even against the law. So, what makes it so valuable? In this video, we'll dive into the history and significance behind the $100 bill. A $100 bill is valuable not only because it is official currency printed by the government, but also because of its scarcity. Throughout history, the value of currency was linked to valuable commodities such as gold or silver, and the amount of currency in circulation was determined by a government's reserves of these commodities. This scarcity creates a demand for the currency, making it valuable and able to be exchanged for goods and services. The value of a $100 bill is determined by the government's ability to control the supply and demand of it, making it valuable and useful as a medium of exchange. After the U.S. government abolished the gold standard in 1971, the U.S. dollar became fiat money, which means it is not linked to any external resource such as gold or silver. Instead, the value of the dollar is determined solely by government policy, which decides how much currency to print. This allows the government to control the supply of the currency and influence the economy by adjusting the money supply. However, it also means that the value of the dollar can be affected by factors such as inflation, interest rates, and government debt. The value of the currency is now backed by the government's ability to maintain a stable economy and the trust that people have in the government and its currency. Monetary policy, which determines the supply of money and the interest rates, is not set by any of the three branches of the U.S. government: the executive, the legislative, or the judicial. Instead, it is set by an independent body called the Federal Reserve System, also known as the Fed. The Fed is made up of 12 regional banks located in major cities across the country, and its board of governors is appointed by the president and confirmed by the Senate. The Fed's board of governors reports to Congress, and all of the Fed's profits go into the U.S. Treasury. However, to keep the Fed from being influenced by political considerations, it is not under the direct control of any branch of government. One may wonder why the Fed doesn't just print an endless amount of $100 bills to make everyone rich. The reason is that this would decrease the value of the bills and render them worthless. The purpose of the currency is to be exchanged for goods and services, and its value is maintained by keeping the money supply in line with the economy. When the amount of currency in circulation increases faster than the total value of goods and services in the economy, the value of each individual unit of currency decreases, making it able to purchase less than before. This phenomenon is known as inflation. It happens when the money supply grows too fast compared to the growth of the economy, causing a rise in prices and a decrease in the purchasing power of the currency. In contrast, if the money supply remains the same while the number of goods and services produced increases, the value of each dollar increases, a process known as deflation. Both inflation and deflation can have negative effects on the economy. Inflation, in which the value of money decreases, can stimulate business by encouraging people to spend money quickly before it loses value. However, it can also lead to overconsumption and hoarding of goods, causing shortages and driving up prices, leading to even more inflation. On the other hand, deflation, in which the value of money increases, can discourage consumer spending and reduce business profits, leading to increased unemployment and a shrinking economy. While both have negative effects, policymakers generally consider moderate inflation to be less harmful than deflation, as it can be easier to control and it allows the economy to grow. The Federal Reserve uses a wide range of economic data to determine the appropriate amount of currency that should be in circulation. This includes previous rates of inflation, international trends, and the unemployment rate. The Fed's goal is to find the right balance similar to the story of Goldilocks, where they need to get the numbers just right in order to stimulate growth and keep people employed without allowing inflation to reach disruptive levels. The Fed uses tools like adjusting interest rates, buying or selling government securities, and adjusting reserve requirements for banks to control the money supply and achieve its monetary policy objectives. The Federal Reserve has a direct impact on not only the value of the currency in your wallet, but also on your job prospects. By managing the money supply and interest rates, the Fed can affect the rate of economic growth and employment, influencing the likelihood of getting or keeping a job. The Fed's monetary policy decisions play a critical role in the economy and can help to maintain steady growth, leading to more job opportunities and lower unemployment rates.